the last recorded month, China added 93 gigawatts of solar in just 1 month. So, when you think about the U.S. and European landscape, things are definitely more modest.
When you look at the Senate finance proposal, keeps almost all of the IRA provisions intact, specifically for 45X manufacturing credits, but it also unlinks batteries from wind and solar. So you can have these standalone battery units taking energy from the grid, participating in energy arbitrage without having to be tied to wind and solar generation. On the solar side, it's a bit of a mixed bag.
So they were awarded 25 or 26, depends if you index inflation onto them, roughly $26 per megawatt hour for a project. So that was very, very supportive for let's say a solar project that you were developing with a PPA price, with a offtake price of 50. It helped a lot of the renewable developers achieve an internal rate of return of over 8%. Somewhere between 8 to 9%.
So I cover the pure renewable developers, and it is a big deal for them. A lot of them have pared back their plans already in the US. And just for context, some of these companies 2 years ago were aiming to add 4 to 5 gigawatts a year, for example, EDPR. Not in the US necessarily, but globally. And now they're aiming for 1 to 2. So it's a huge drop in growth.
Good morning, good afternoon, everyone. This is Rob Barnett from Bloomberg Intelligence, and today I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. If you've been following all of the geopolitical developments and their impact on oil and gas markets, I highly encourage you to go back and check out our rapid response webinar that we did on Monday of this week. And we also had one the prior week, very specifically focused on the escalating tensions between Israel, US, and Iran. So make sure to check that out if you want to go deeper there. Today, we're going to pivot a little bit and talk more about some of the tax reform issues and developments related to the clean energy landscape. So for the call today to do that, we have 3 regulars. So we've got Patricio Alvarez joining from his usual perch in Madrid. Also in Madrid nowadays is João Martins, who also works in the gas and utility space in Europe. And then swinging over to London, we've got Alessio Mastrandria. So this is the crew for the call today. And if you haven't been following it, there have been lots of back and forth in the U.S. House and now Senate on changes to the Inflation Reduction Act. And so if you're following the credits that are relevant for the solar industry, the wind industry, the hydrogen industry, the carbon capture and storage landscape, biofuel space, there's a lot of moving pieces there. But the House version of the bill that passed a little while back took a lot of the credits that were in the IRA and phase them out, sunset them earlier, put conditions on it. The Senate version of the bill, perhaps a tad more generous for the evolution of those credits. And then there's been some drip of news out over the last few days where maybe there's going to be even some better incentives or more generous incentives added back in before Senate actually passes the bill, at least according to some of the senators who are out there speaking on it. So Patricio, let's get your read on this first, simply because a number of the European utilities and IPPs, that sort of thing, have been active in developing renewable capacity over here in the US. And what's your read on kind of the lay of the land for those guys? Are we going to see continued investment in the U.S.? Is all of this tax policy uncertainty going to pump the brakes on the types of investments they've been making?
Sure. Thanks, Rob. So yeah, I'll try to summarize the changes a little bit from the different versions of the bill, and I would say that the overall conclusion is that even the Senate version, although it looks less severe than the House version, it's still a significant departure from the original IRA provisions, which by and large benefited the renewable developers mostly on the production tax credit. So they were awarded 25 or 26, depends if you index inflation onto them, roughly $26 per megawatt hour for a project. So that was very, very supportive for let's say a solar project that you were developing with a PPA price, with a offtake price of 50. It helped a lot of the renewable developers achieve an internal rate of return of over 8%. Somewhere between 8 to 9%. And when you compare to the cost of capital of these companies, which is on average around 6%, it gives you a healthy spread of 200 to 300 basis points. That would be the baseline sort of Inflation Reduction Act full credits with a PPA price of 50. Since then, well, the House version basically just tried to repeal those credits almost immediately. If you did not start construction of a project within 60 days of the bill's enactment, you would not be eligible for any credit. So it was an effective repeal. Where we are now, and this excludes any of the recent rumors that you talked about in the beginning, the Senate version now is just an earlier sunset or a more gradual sunset of these PTCs, of the production tax credits, which basically propose that you can still secure 100% of the tax credit if you start construction before the end of 2025, which means that a lot of these renewable developers could safe harbor those tax credits, which means that they'll invest 5% of the total capex for the project in order to secure the full amount of the tax credit. The tax credits will then be phased out to 60% in 2026 and 20% in 2027, and then they'll cease to exist in 2028. So it is still a bit hard to read what the capital allocation strategy, how it will shift for renewable developers from Europe. By and large, these companies have already pared back investment in the US, and we're talking significant cuts. Since the end of 2024, we've seen capex cuts of anywhere in the region between 15 and 25% cuts already, mainly focused in the US. So our view is that although the Senate version is not the worst case scenario, it will make a lot of these companies sort of reconsider their expansion plans, and we don't expect, a strong rebound in the capital allocation into the U.S., at least not in the near term. And the caveat there is that we run the numbers and actually saw that even with a 60% PTC production tax credit, you would need a higher offtake price of about $56 per megawatt hour to still secure that spread over the cost of capital. So meaning that projects can still be economical. But again, we will need to see that price uptick in the offtake prices, which, there's a story there about AI and data center demand that's pulling up demand for renewable projects and of course for gas-fired power as well. So I would say it's not the worst case scenario. We still think, there will be strong demand for renewables in the US. It's just hard to gauge at this stage right now how it will pan out over the next 2 years until we see the final version of the bill.
Patricia, I just want to get a little bit of follow-up there. So if the European exposed utilities are sort of going to have a less and lower capex in the US, does it just translate into lower total overall spend, or will they just deploy capital into Europe or other markets instead?
So it will definitely mean that there will be a recalibration of the mix. We don't expect capex to continue growing at the same pace that it has been over the past 3 years or so. In Europe, mainly, we've seen capex increases of over 30% per annum for the 3-year plans for utilities, with the mix turning more towards European grids. So roughly speaking, we will see the sector level capex sort of flatten out or plateau at 100 billion per annum, but a higher share into European grids. And in that mix, you will see companies that are focused on renewables, they won't have optionality to replace a market like the US easily. So that could either like open the door for some of these companies to shore up their balance sheets and improve their shareholder returns in Europe, and that was sort of the supportive case for our focus idea on RWE, which is a company that's heavily invested in the US, but has recently pared back their investments, and since their balance sheets looks good, and we don't see a lot of opportunities in the near term for them to deploy that capital, we expect them to actually extend their share buyback program here in Europe. So that would be sort of the summary. It's like grid spending, companies that can invest in grids will boost the spending in that segment, and renewables will probably sort of turn more selective on growth and reward shareholders where they can.
One more follow-up. So just curious to get a sense from you of what type of return profile can you expect from renewables investment in the US versus Europe? Is there a more optimal market right now? Do you get higher returns in one market versus the other? And just to clarify too, because it sounds like grid spending is the sort of probably the highest return investment if that's where folks are chasing most or allocating at least more of their capex toward these days. Is that the right way to interpret that?
Yeah, well, your first question is there's a caveat to that. So is it are margins in the US healthier? They are if we retain the tax credits. Because if you look at the offtake price on average in the US, it's a bit lower. So it's around 57, I think, for solar at the moment. It's almost 60 in Europe, where you don't have those tax incentives. So that makes us imply that the margins in Europe are a bit thinner. So if anything, the removal of the tax credits will make for more competitive markets in the US, more comparable to Europe. We should also mention that several markets within Europe are more competitive already. So we have lower power prices already here in Europe. So for example, Spain is a very, very tough market for solar developers, for example. There's also a lot of smaller developers. We don't have those sort of trade barriers for Chinese manufacturers and equipment, or at least not as high as they are in the US. So that makes us believe that returns in the US for now are more attractive. And in terms of the return profile of grids, the cost of capital for grids is higher, but grids do offer a guaranteed return, which I think is what's making utilities invest more heavily into that. There are three vectors or three drivers for that. It is that at least in Europe, so renewable penetration has already impacted power markets, and an example of that is Spain's blackout on April 28 just highlights that we in Europe we need to ramp up investment in flexibility infrastructure and response. So investing more in the resilience of the grid and also in battery storage to sort of level off that excess renewable power. And then the other one is that utilities don't need to compete with smaller developers in grids. They do have, by and large, natural monopolies. And third is the risk profile. Like these are guaranteed returns by a regulator that you can count on almost fully for the next 5 years. Like there's a lot of visibility, and that I would say are the three main drivers of why European utilities are turning more defensive.
Okay, thank you. Alessio, let's get you into the conversation. Patricio just mentioned batteries, and I know you've got a note out that looked at some of the changes to U.S. incentives, and one of the areas where there still looks like there's a decent amount of runway is on the battery storage side. But just general, can you frame how the changes could affect across, say, what's your general assessment on solar? What's your general assessment on wind? And what's your general assessment on sort of the battery storage space, taking into account all the evolution we're seeing on the tax policy front?
Thanks, Rob. Sure. So if you break out the three subsectors, the way I would rank the new proposal by the Senate Finance Committee would be battery first, then solar, and then wind. Battery, when you look at the Senate Finance proposal, keeps almost all of the IRA provisions intact, specifically for 45X manufacturing credits, but it also unlinks batteries from wind and solar. So you can have these standalone battery units taking energy from the grid, participating in energy arbitrage without having to be tied to wind and solar generation. On the solar side, it's a bit of a mixed bag. So on the utility side, they preserve the tax credits through 2032. They no longer have the cliff in 2031. However, they did add a domestic content adder. So you, starting in 2026, in order to achieve, receive the credits, you would need to have 60% of your production in the US, and that scales all the way up to 85% by 2029. On the resi side, unfortunately, they 180 days after this passes, they're going to be pulling the residential credits for solar. Yesterday, I believe Republican Senator Kevin Cramer indicated that the final bill may be more generous to utilities or residential solar, but that's to be determined. And then on the wind side, the tax credits will dry up after 2028.
Okay, thank you. Zhao, let's get your response on this as well. So some of your companies, I believe, are also active in the U.S. Landscape, and I'm just curious, how much do you think the policy tax incentives really matter? Is the change that Alessio and then Patricio were just laying out, does it affect kind of how the spending patterns that you're expecting out of your space?
Yeah, so I'd echo a lot of what Patricio said. So I cover the pure renewable developers, and it is a big deal for them. A lot of them have pared back their plans already in the US. And just for context, some of these companies 2 years ago were aiming to add 4 to 5 gigawatts a year, for example, EDPR. Not in the US necessarily, but globally. And now they're aiming for 1 to 2. So it's a huge drop in growth. A big portion of that comes from the US, although until now the US was still the last place where these companies were trying to invest a lot, because with the tax credits it was high return and largely a lot of government support. Taking that away means that they cannot, or from at least beyond 2026, they are likely not going to invest as much in the US. That can go to minimal levels within CapEx for at least a few years. And then that means, okay, what else can these companies do? Can they invest in Europe? It depends on the specific company. There will be peers that have more flexibility to invest in Europe if they are present, for example, in markets such as the UK and Germany, where we still see a little bit of growth. But it also depends on their funding capacity. And a lot of the pure renewable developers, as opposed to integrated utilities and some of the other peers, they are highly leveraged, and they need to correct that before investing, whether in the US or in Europe. Some of these peers have net debt to EBITDA at above 4x versus a couple of years ago, only 2x. So that is a really critical concern that investors have at the moment, and they'll have to correct that before investing. So that will be the priority. And then some of them, and perhaps not so much the pure developers, but some of them could look at opportunistic buybacks and other strategies to deploy capital, which is not the case right now for developers.
Shao, it makes me chuckle a little bit here, and you talk about additions of 4 to 5 gigawatts a year. I think last month, or the last recorded month, China added 93 gigawatts of solar in just 1 month. So, when you think about the U.S. and European landscape, things are definitely more modest. Can you give me a sense of where the pendulum is swinging in Europe right now? If you crystal ball, kind of how much capacity additions over, say, the next 5 years will be split across wind and solar, hydrogen, batteries, gas? Like what's the portfolio looking like over there these days?
Okay, so starting with renewables, Europe is aiming to add 90 gigawatts this year. That's broadly 20 wind and 70 solar, which is not unrealistic. Last year, I think we added nearly 70. Looking at the pipelines from our utilities, which might represent about a third of those, a big portion of the solar part is residential. So a third of the 90 might come from our utilities and related companies. They are accelerating a little bit still. This might be the last year. And so that's a credible target. I think probably will remain at around that run rate for the next 2 to 3 years. That's on renewables, still growing. We think within the power mix of Europe, it's the only area that is clearly still growing. We think generation from renewable sources might grow above 10% a year based on these additions. But obviously, just in terms of the outlook and the investment sentiment, it is deteriorating a little bit. The other part of the energy, well, a few other parts. So we're phasing out coal in Europe. That continues to happen. That's not slowing down. Although there might be some risks into the second part of the decade, towards the end of the second part. As we phase out coal, we need we need to have another flexible source, which will bring me to gas. But the coal plant phase outs continue to advance, especially in Germany. Nuclear has been phased out in Germany. In Spain, there's an ongoing discussion about whether it will happen or not. But for now, the plan is to phase out nuclear. And so what we think is that this might result in a slightly better role for gas than what we've anticipated over the last few years. For context, gas demand in Europe is still seen by most forecasters, is still seen going down. For example, the IEA expects gas demand in Europe to drop another 10% by the end of the decade. But we think as renewables slow, if we want to continue advancing coal and some alternative green gases the growth there is also very protracted. The role for natural gas might be a little bit more resilient than we anticipated before. And then just the last portion on hydrogen, for example, which could be an alternative to natural gas. There's a lot of plans there. The EU aims to build more than 50 gigawatts of electrolysis capacity by 2030 from nearly zero now. We think that's not going to happen. They will miss that by a lot. But it is it is a growth factor that might support some of these gas utilities as they build the regulated assets necessary for that. But also that is very protracted. It's slower versus than expected. And so everything points to a more stable gas role than previously.
Fantastic. Thank you, Zhao. Just a quick bit of advertising. This group here, we will all be in the same room together on July 10th for an event in London. It's in-person roundtable. So for everyone on this call that's London-based, make sure you come join us for that. We'll take you out for a pint afterwards if you want to come say hello in person and talk about some of these topics in more detail. And then the following week, the week of July 14th, we will host a similar event in Madrid and probably a couple other European cities. We're still sorting out the details. But so if you're Madrid based, you probably already know Zhao and Patricio. But if not, ping them. We'll get you looped into the details on that as well. Okay. And let's continue the conversation for today right now, though. But Alessio, I just want to get your response to what Zhao was just thinking about. We continue to see massive renewable numbers, both on the wind side and the solar side, coming out of China. How does this stack compared to the US? And when you think about the Western listed names, you know, your Vestases of the world, your GE Vernovas, your First Solars, you know, how are they doing in this landscape? Can they compete against China? What does their outlook look like for the next couple of years?
Sure. So just to give you a sense of grid development in the US, the EIA put out that 63 gigawatts would be added to the utility scale grid in 2025. 85% of that will be solar plus batteries. Another 12% of that will be wind, and the rest is going to go to natural gas and other. So, despite these uncertainties around the tax credits, this is still sources of energy that are quick to build and relatively cheap. So demand is unlikely to be stopped too much. Where we might see a bit of a pullback is in margins. When we put our note out, we highlighted GE Vernova might have difficulty achieving its 2028 EBITDA target of 10%. Vestas has a similar target, but given their European reliance, 60% of their backlog is located in Europe, another 15 to 20 is in Asia. They're likely to still be able to clear that target. I think they factored that in. On the solar side, we've talked a lot on this call about First Solar's premium for solar panels in the US. They sell for about 30 cents a watt. With the IRA, they get another 4 cents a watt, I believe, as a COGS reduction. So we believe that their margins are going to likely be preserved through at least the end of this decade.
Thanks, Alessio. Patricio, I want to come back to you on some broader landscape issues. I think when you kind of think about the power mix and capacity addition mix over here in the States, the way I would generally describe the trend is additions are overwhelmingly weighted towards solar and then storage, then a little bit of wind, then a little bit of gas. You are seeing gas continue to take higher market share and generation here in the US. But how does that contrast with your thinking on Europe? What's happening there? And and where I'm headed with this is I want to get a vibe check from you on just where gas demand is potentially headed in Europe. Is it stable, declining? And how does it frame against all the types of new additions are being added over there?
Sure. So in terms of gas demand, I think a good place to start is to look at how it's been evolving over the past 3 years. So the energy crisis in Europe really marked an inflection point for European gas demand. We've seen significant demand destruction since the war between Russia and Ukraine broke out, which led to the suppression of roughly 80 billion cubic meters of piped gas supply into Europe. Since then, gas demand has dropped almost 20% between 2021 and 2024. And these are sustained declines. Every single year it has declined. And now in 2025, we're expecting to see somewhat of a rebound. We expect gas demand to rebound as much as 2% this year. And although most of that is driven by higher heating demand, so we had a colder winter this past winter versus the last two, so that adjustment will support that rebound. But over the longer term or the medium term, I would echo what João was talking about as well, is that if Europe continues to decommission coal plants at pace as it has over the past 3 years, so we were talking about 10 gigawatts plus of coal plant closures per annum. If we want to continue at that pace, and we don't have enough battery storage, so battery storage capacity in Europe is still very nascent. And if you compare it to certain markets in the US where it's actually surging. In Europe, the economics for batteries are not very clear yet, and it looks like they will need some sort of regulatory incentive, some subsidy in order to take up properly. So it's the lack of options really that makes us believe that although we don't expect that drop in gas demand to revert all the way back to what it was in 2021, we do think perhaps all these forecasts of a significant decline in gas demand over the next 5 years may be overstated. Because if we continue deprecating coal and nuclear capacity on a net basis across Europe, it's still poised to decline almost 1% per annum for the next 10 years. So that's just, we're building reactors just to replace the ones we're closing here in Europe. So that makes us believe that, the gas will have a larger role. And one example is clear in Germany, for example, the new coalition there is trying to move along a tender for 20 gigawatts of new gas-fired capacity, which the previous government had a lot of trouble trying to get off the ground because of a hydrogen-ready component. Like they needed the new gas plants to be ready to switch to hydrogen, and I think that complicated the tender process. Now the new coalition, which is believed to be more energy agnostic, let's say more pragmatic, and will just try to get things done in order to lower energy bills in Germany. We do think that perhaps that will move along at least the first tranche of the tender, so 5 gigawatts. Over the next 12 months or so. So to your question, I think that is a clear example that we're becoming a bit more flexible in how long we will use gas as a bridge fuel.
Yeah, very interesting to observe that evolution. I'm curious, maybe this will be the final place we can go here with the call today, is just to get a readout on where hydrogen fits into the equation. And I ask because for some time there in Europe, you saw lots of talk about doing offshore wind and having just gigawatts after gigawatts of capacity available to basically run electrolyzers to create hydrogen. And you had all this talk about a hydrogen economy. Is that real? Are we really going to see that kind of thing happen in Europe? Or is it going to move to a much more of a conversation about, just filling the gap on maybe battery storage, having more gas in the mix, like you just said? So just give us a vibe check on where hydrogen's at. And João and Alessio, I want to get your input on that as well, but we're coming to you first, Patricio.
Sure. Yeah, I will try not to step on João's toes too much. But I think if the way that the policymakers in Europe have foresee the evolution of the power mix versus what is going on in the ground is not always connected. So solar capacity is growing much faster than most policymakers' initial expectations. So that makes us think that because that is the most economical solution, the easiest, the fastest, the cheapest out of the mix. Because you could argue that we need more gas-fired capacity, but people cannot install gas-fired capacity in their homes. They're installing rooftop solar. It is really the economics of it that is moving that forward. And wind is somewhat falling out of favor because you will need specific locations to that have the wind resource for those assets. So it makes it harder to secure because of the permitting, because of supply chains. There is heavier capital investment initially. When you compare it to solar, when their load factors are not that different, I think solar has a clear advantage. And to your point, like things that don't need that much red tape. I think battery storage, once we figure it out, I think in Europe it must take off because hydrogen, like João said, the targets seem very, very ambitious. We're like to ramp up 50 gigawatts of electrolyzer capacity over the next 4 years and a half from virtually zero. Seems very ambitious. So my way to read the way I read it is perhaps renewable capacity growth will slow, but we'll continue building, but we'll need to pair that almost one-to-one with either grid investment or battery storage in order to sort of, optimize the renewable source and perhaps a longer life for gas.
Maybe just a quick follow-up. What company in your remit has an outcome that's most geared to the vision you just laid out?
That's a great question. There's two companies that align with this sort of transition, like flexible gas transition, renewables plus gas transition. That is definitely Engie. That's a French diversified utility with exposure to the US, and RWE. Those are the two sort of strongest transition stories, I would say, within my coverage.
For anyone listening, if you don't know how to do this, if you load the ticker for RWE, so RWEGY, and then type BICO, B-I-C-O, you can go read Patricio's outlook on the company. You can do that for any company we cover. Okay, Zhao, let's come to you next. Tell me your thoughts, same question, and perhaps highlight a company as well.
Yeah, so I mean, I fully agree with Patricio. Looking specifically at hydrogen, what we can say is that not much has happened so far, and that's an indication of probably where things are going to go. Just to give you another example of targets, the EU, I think, targets about by 2030 to produce or import about 20 million metric tons of hydrogen per year. And Bloomberg NEF estimates they will do maybe 20% of that. So very ambitious targets, not a lot happening right now on the ground. A lot of that is waiting for regulatory support. So there's two sides of the hydrogen space, production and networks. On the production side, demand is still not there, and that's the primary reason why a lot of projects are not going forward, because they cannot find people to contract the sales, the output of the projects. On the network side, there's no regulatory framework akin to gas for now. That might happen before 2027, but until that happens, no one is going to commit capex. So that's the problem on hydrogen. And like Patricio said, I think the two offsets of that on the energy mix is, one is batteries, and the second is probably natural gas keeping a bigger role than previously expected. In terms of companies, I mean, I cover pure plays, so they're all either 100% one side or the other. I would say on gas, one company that we're very positive fundamentally is Italgas, which is also exposed in Italy, is a market where energy security has been an important topic over the last few years, and that has allowed them to both them and Snam to invest a bit more on their gas assets. And yeah, I'll leave it as that.
Question for you on just Italgas. Are they doing any blending of hydrogen into their network? I feel like Italy was experimenting with that idea of H2 blending within the gas pipeline system. Is still seeing any of that over there in Europe?
Yeah, so it's being less and less discussed, I would say. I mean, among the three pure play gas grids that we cover, which is Italgas, Enagás, and Snam, they all do a little bit of it. So they're either converting their networks or new portions of the network that they're building. They're aiming to have it ready for hydrogen transport. But I think for companies that have a clear earnings runway within their gas story, so if they can grow their earnings and have an equity story based on the gas assets, I think they are, generally speaking, less and less about hydrogen, while it remains an important driver for some of the peers that are not allowed to invest as much on their gas grids.
Fantastic. Alessio, let's come over to you. Give us your read. Okay, so what do you make of the hydrogen thesis versus, say, storage, and kind of lay out your vision and give a couple companies that are geared to how you're thinking about the world? Sure.
So I was reading earlier that Germany is investing about 9 billion euros to develop 10 gigawatts of electrolyzer capacity by 2030. If you compare that to solar, you were just saying earlier, we're getting 90 gigawatts in 5-6 months out of China for solar. And we frequently write about the overcapacity of solar manufacturing. Last year, the world installed nearly 600 gigawatts, but there's capacity for at least a whole terawatt. So I don't see hydrogen. Well, I don't think hydrogen's not a great technology. I just don't think it's something for this decade. And then some companies to maybe look at, going to harp on the battery storage names a little bit. You can look at SolarEdge and Enphase for the residential side, and then for the tech and systems, I can look at EOS Energy, ESS Tech, and T1 Energy.
Fantastic. Thank you for that, Alessio. And just to clarify, I believe China's solar number for it, for the full year to date, is over 200 gigawatts. I think it was 90 gigawatts just in 1 month or around there, right? I didn't
think
see
you're right.
the full
In
numbers,
May, right?
it's just a staggering. I mean, if you were to annualize the number, it would imply that China was doing over a terawatt a year of additions, which I don't think you can't annualize the number. I think they were racing to get stuff in the ground to get some subsidies that were there was a deadline on some things in China, so that's why you saw the bump. But still, big numbers out of China, no matter which way you peel the onion. Okay, so I think that will do us for today. For everyone on the call, we hold these every Wednesday. The topics change. We pull in various groups, for various analysts from the energy team. We often host folks from other companies as well. So if you want to join us, you've got recommendations on a speaker or a company you want to hear from, just reach out, let any one of us know, and we'll try to sort of help facilitate that. And again, like I said, if you're London based, we'd love to see you on July 10th, and we will have a few other European focused events that you can attend as well if you're not based in London. And of course, we're regularly holding stuff in the U.S. We just don't have anything in the coming month over here, but we do want to meet all of you in person as well. Make this more than just a virtual conversation. So, and reach out anytime if you have questions to any one of us. We're all green dots on the terminal right now, and happy to follow up on any of the topics we discussed. Take care, everyone, and hope you have a great rest of your week. Cheers.